So I want to start with the US dollar, Canadian dollar, and just before I say anything, my general bias is this pair. As you can see, I got a weekly chart open, and until 0.618, which is about 1.35, just below or just around the psych zone of 1.35, that's my short-term target that a technical trade would take place towards. This is a weekly chart. I usually glimpse at it. The daily usually serves as my long-term trend bias. The weekly, just one step, like +1, a factor of 1. I usually try to look at the chart right above. And also just below, for my tactical entry, if I'm looking at a 30-minute, I might glance at the 15-minute. But ultimately, my trading surrounds around, technical analysis surrounds around daily, longer-term sentiment, 4 8 hour, usually like the 4 hour would be intermediate term, intraday, short-term trend sentiment would be between the strategic daily and the tactical 30-minute, and then the 30-minute, maybe the 15. Those two I consider one. Those would be my tactical entry. So it would be like strategic all the way down to tactical. Now this, that's like a top-down multi-time frame approach. I like that approach. Before I start anything, I want to say, just as an above the trees, I did basically a Fibonacci ratio from the previous local high here all the way down, and this is a weekly chart, so this goes all the way back. Not really local, this is like absolute in a sense. All the way down to the wick, which I like to capture the extreme. Some people use the bodies, I like to capture the absolute extreme. And then this retraces all the way up here, and you see how it surpassed 38%, propelled it up into this little bowl pattern. I want to point this out. That is a textbook cut pattern, excuse me, and basically it does this little, it's usually a higher time frame pattern, and then it stops into like a descending a descending flag pattern, and then essentially drives back up. We're about right here, and if we jump back, you can see that we're right here. See a little bit of a descending, and then back up. My target on a trade would be to catch this little dip, which we will get in the lower time frames. Catch it on the consolidation and retracement up to this 1.35 level. If you want to do like a swing trade, I would capture it right there. Honestly, I think my general sentiment is since the Canadian dollar increases in price with a rise in oil prices normally. Sometimes they say that the U.S. petrodollar denominated international trades and things of that nature would actually cause both pairs to go up with the price of oil. But assuming that the Canadian dollar acts as a commodity currency, the lowering price of oil would put upward pressure on this pair as the Canadian dollar would rise, and since that's in the denominator, this overall pair with the drop in oil should increase the Canadian dollar, and then drop in the price of oil should decrease the Canadian dollar and ultimately increase this pair. And then the anticipation of the U.S. Rate hikes should put upward pressure on the USD pair. So ultimately, over the intermediate term, I believe that this thing's going to eventually get right up about here to the 76% level, the Fibonacci line in the sand, the level that it ultimately should stop at, and then start dropping down again if a technical reversal isn't going to be realized. But over the shorter term, for like a shorter swing trade, I guess you could say, this would be the target. It doesn't look like a lot, but this is actually about 350, 400 pips, 350 pips give or take from here to there. So that would be the play that I was looking at. And now I want to end this video just to make it short, and I'll jump down to the next time frame on the next video. Thank you.